Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's turn to credit. A rally in corporate debt gaining momentum despite fears of sticky inflation. Spreads on US high-yield bonds falling to their lowest since January 2022, even with markets pushing back rate cut expectations. Blue Owl is one of the beneficiaries of the credit boom, seeing its shares soar more than 70% over the last year. Marc Lipschultz, the co-CEO of Blue Owl, joins us now for more. Marc, good morning to you.
Good morning. Great to be here.
Let's talk about what's happening in the world of credit. So we had the rate shock last year. Lasted about 5 minutes. Some banks failed. We moved on really quickly. Started this year by thinking about commercial real estate, CRE, who's going to be next? Are we going to have this credit stress? Of the 350 portfolio companies that you're across, any distress whatsoever right now?
The portfolio is strong. The economy read through our portfolio looks quite positive. Certainly, wind back a year, and I imagine if we were all sitting here, I had the privilege of having this conversation with you a year ago, I think we'd probably all be talking about what type of recession would we be in right about now. And we're not. You know, I look across those 350 companies, and you look, last quarter, our companies on average grew 15%. Their EBITDA. So that is, now these are very selected. Obviously our job is to find great companies and to make loans to really strong businesses that have a lot of potential, a lot of growth, and where we can therefore have a lot of cushion in our loans. But nonetheless, if our portfolio is growing 15%, we are not in a recession nor on the edge of it. And we don't see the normal indicators yet that would suggest a meaningfully weakening economy.
Do you find that your portfolio companies can handle paying 10, 12, 14% interest rates and survive and thrive? Are the higher yields that we're talking about not restrictive based on the growth that they're projecting?
Cutting through it all, they're doing fine in that context. I think what we now know from what we didn't know a year ago was this speculative question of, with rates rising to levels, of course, we hadn't seen in many people's working lives. They hadn't even experienced interest rates that had like a positive number to them. But in any case, at the end of the day, what we now know is we have a full year of those rates have run through the P&Ls of these companies. And I mean, of course, by definition, there's going to be an incremental company that will struggle more in a higher rate environment. But writ large, no, that has been absorbed by the system and quite successfully. We see it. We're not seeing these waves of changes or even the precursors to them, like asking for lots of amendments or meaningful changes in, hey, can I pay in more debt? Can I pick my interest instead of paying in cash? So the indicators that are not even just we would suggest an issue, kind of have to predate an issue, just aren't there in any meaningful degree yet.
Which is fascinating to me because we talk about, is it restrictive, and then have companies actually felt this? You're talking about floating rate note loans, so you're talking about companies that actually are handling higher benchmark rates now, not necessarily waiting to refinance. How has it affected the demand, given the fact that companies have seemed reluctant to borrow to fuel growth given the higher rates?
So indeed, look, our specialty is senior secured floating rate debt. So to your point, you know, this environment has been very good for us, good for our investors. It's raised on a quite quick basis the returns people earn. Of course, that's the point, to be inflation protected in our kind of product. So companies have absorbed that pretty successfully. People are borrowing capital. You know, at the end of the day, again, of course, supply and demand, we all know more expensive capital means people are going to use perhaps less of it. But in the world of private equity in particular, in buying a company, and I started in private equity myself back in 1995, wasn't even called private equity then. And at the end of the day, that cost of capital, it's a bit of a calculation, right? It's how much you can pay for that company. Of course, it reduces the value you can pay for an enterprise, but it really isn't prohibitive to conducting activity. What you really need is an environment where people have a common set of expectations. It's really more about the gap between buyer and seller in terms of their expectations than it is the absolute numbers.
Was it easy back in the 90s compared to now? Was there less competition? How different was it?
Well, it was a lot different, that is for sure, and there was certainly a lot less competition. If you look back to 1995, when I was lucky enough to join KKR, there were two large private equity firms, LBO firms, as called then, at the time, Forsman Little and KKR. The world now, we're talking thousands and trillions of dollars of capital.
Everyone wants a piece of this, and I think there's a worry that maybe it just ends up with people chasing the same deals, they're sloppy deals, and maybe the traditional lenders get squeezed out. Is that how you see things at all?
So the opportunity, by virtue of that evolution of the market, trillions of dollars of private equity, what we saw at Blue Owl was the opportunity to create the financing source to meet that need. Now, this is a very young industry comparatively. When we talk about that very point, thousands of private equity firms, amongst the folks that focus on the large area, we focus on the very largest financings, very largest companies. There's just a few of us. So it's a very young industry by that measure, and I think, therefore, a lot of opportunities ahead.
To his point, though, a lot of people would argue that we know what's going on with some of the public markets because basically you've seen the best and the brightest kind of weeded out and others kind of fall out of bed and maybe gone to the private markets. There's sort of this question of, is there some behavior that could lead to higher default rates that could be somewhat masked by the lack of transparency? Do you buy into that? Do you see colleagues that are operating with, say, maybe less or lower standards than yourself?
I believe that the private market has fundamentally added a stabilizing influence in total. Now, of course, again, you're going to have a dispersion of different participants. Some will do better than others. We're intensely focused on credit. That has been where we have lived. We've done about $90 billion in loans, and our running loss rate has been 6 basis points. So there really is a durability, but more important for the markets writ large, having a steady source of capital through ups and downs. During the pandemic, we were still providing capital. During the run on the regional banks, we were providing capital. When inflation was surging, we were still providing capital. So a healthy system is not one where private markets take over from the public markets, but it is one where you have a large, vibrant private market alongside a large, vibrant public market. That is a better economic platform.
You inked a pretty big deal last fall with Mubadala. Do you see more interest from some of these sovereign wealth firms, particularly in the Middle East?
We do. The private lending, direct lending was adopted, I'd say, generally speaking, earlier by U.S. institutions. And part of that, I think, is just the maturation to a degree from really 10 years ago, this flavor of direct lending, the lender of first choice, as opposed to lender of last resort, really didn't exist. So this is kind of a 10-year industry in that regard. And now we're seeing an increasing interest with non-U.S. investors. Part of it, I think, is now appreciating the durability. It's a so to speak, a safe haven. Where do you want to be when times are uncertain? You talked earlier about the dispersion of views. I think where you want to be is senior, secured, floating rate. So I think that the non-U.S. investors are appreciating that being a core holding. And at the same time, just look, the absolute returns, when you can generate double-digit returns, taking that very senior position, that very moderated risk, that absolute level of return starts to really resonate for people in non-U.S. markets as well.
Can I finish with a terrible question? Is there evidence whatsoever, any at all, that this Fed is sufficiently restrictive, based on what you see in your world specifically?
So here is what we see in our world. Inflation's a sticky animal. We saw it starting a year ago, and there's plenty of things. We're not macro prognosticators, but 350 companies looking bottom up, we continue to see inflation be sticky. There are offsets for sure. Look, shipping costs have come down dramatically. We have a consumer products company that was paying $20,000 a container. Now they're paying $3,500. But wages are sticky. Wages are still rising. So we are not through the teeth of this inflationary challenge. We're through the worst of it, but we're not done with it.
This was probably better to get your answer than ask another economist this morning. Marc, it's good to see you. Thank you, sir. Marc Lipschultz there of Blue Owl Capital. I think the answer, Bramo, I think you heard the same one, right?
I mean, basically, no, because if we're looking at companies that can handle higher borrowing costs and are still hiring and still expanding, where's the restrictiveness?
It's pretty revealing. Here's the latest this morning. Shares of Hapag-Lloyd lower in Germany after the shipping giant reported a decrease in earnings and warned of a further decrease in 2024 on a, quote, volatile and challenging economic and political environment, especially in view of the current situation around the Red Sea. Rolf Habben Jansen, the CEO of Hapag-Lloyd, joins us now for more. Rolf, great to catch up with you, sir. I want to talk about freight rates. When freight rates first started picking up earlier this year on the back of this story, there was a sense from some people that maybe that was temporary. Do you see that as the new normal now, and ultimately are they going higher?
I think we saw an initial reaction was especially spot rates went up a lot because that's a combination of everybody then trying to book things quickly. We were running up to Chinese New Year and a lot of uncertainty. I think right now we see that the services are stabilizing, which means also that the market is getting calmer. And as a consequence of that, I think we also see spot rates in particular coming down. Just how much time and investment has gone into finding alternative routes? Are you considering more land routes? Are they viable given the increase in rates that you've seen? I mean, we have opened up a number of new land routes, and we've also taken on some additional ships. And of course, we've also had to buy a lot of additional containers because as all the voyages have become longer, we in reality also need more boxes to transport the same amount of cargo.
Rolf, how easy is it to pass along the extra costs associated with this to the shippers, to the consumers, to the companies that want to ship?
I think we see by and large that these costs are being passed on, and I think that's also reasonable. I mean, if you compare the situation now with what we had at COVID, there, of course, rates exploded. Today, you have a different situation because there was probably some spare capacity in the industry when this crisis hit us, and that has certainly helped us to keep global supply chains going and also to keep the increase in cost within reason.
So if there isn't any pushback, why are some of the profitabilities coming down? Just simply because if you can pass it along, are people shipping less? Are they looking to different routes that are shorter?
I think right now you are still looking at the results that come out on companies in the fourth quarter, where we had exceptionally low rates that were way below cost. That's also why a lot of companies posted losses. I think you will see a recovery in freight rates when you start looking at the first and second quarter. The question is, of course, what's going to happen once the situation around the Red Sea normalizes.
I want to talk about the situation in the Red Sea. The United States seems to be in a cycle of defense, not deterrence when it comes to their posture. Are you seeing any signs of deterrence from the United States or the UK or others when it comes to the Houthis?
Well, first of all, let me say that we really welcome all the efforts that are being undertaken by the U.S. and their allies to try and stabilize that situation. But of course, it's very difficult because it's a fairly large area that you need to defend. And so far, we have seen that the attacks of the Houthis continue. And that also means that we will then decide we have no other choice than to keep our people safe, even if that means that, some of the supply chains are then 7 or 10 days longer.
Well, what are governments telling you about securing the Red Sea? Do you have a timeline of when you think you could start using that route again?
I think there are many different opinions on when that is going to happen. I think we hope that we're going to be able to go back through in a couple of months. But I know there are also people that think that it may last quite a lot longer.
Rolf, thank you, sir, for the update. We appreciate it. It's an important story. Has been for the last few months. Rolf Habben Jansen there, the Hapag-Lloyd CEO. Jay Bryson, Chief Economist at Wells Fargo, joins us now for more. Hey, Jay, let's get into that. CPI upside surprise. PPI upside surprise. Going into next week, Jay, what kind of changes, if any, would you expect from the outlook from this Federal Reserve?
So, John, in terms of the macroeconomic projections of the Fed, I'm not expecting a lot in the summary of economic projections there. You were noting earlier in terms of the dots. I mean, it would only take 2 members to switch from 3 rate cuts to 2. So the median could potentially change next week. And I guess, if there's an upside risk here to the projections for next week, it would be to a little bit higher inflation and maybe the median dots shifting up as well. But in general, I wouldn't expect huge changes from the statement next week or from what Chair Powell says in his press conference relative to what they've been saying recently.
Have you changed your view, though, Jay, about the idea of how sticky inflation is and how long it's going to remain high in the face of a labor market that really doesn't show signs of cracking?
So to answer your first question there, Lisa, yeah, we have pushed back we initially thought the first rate cut would come in May. I mean, I think that's kind of off the table, more or less, at this point. We've pushed that back to June. And, I guess what I would say is I think the risk to our forecast would be skewed towards later. That is, I would say the probability of July is higher than May at this point. But in general, we really haven't really changed our views all that much. And in terms of the labor market, I mean, so we saw these initial jobless claims today. Now, I wouldn't make a lot of just 1 week sort of data. If you step back and you take a look at it, what we are seeing in terms of the labor market is the quits rate has coming down really quickly. The job openings is also coming down as well. And then if you look at the unemployment rate, that is starting to move higher here. And, obviously it's at a very, very low level still. So what we are seeing is we're seeing some softening in the labor market. It's not like it's falling apart or anything, but that should, as we go forward, continue to bring the employment cost index lower.
How long are we going to remain in this limbo? We're trying to understand what the trend is, and you've got people who are saying the sky is falling, inflation's reaccelerating, take a look at 3-month and 6-month trailing averages, and other people say, cut it out, it's on a downward trend, you're being overdramatic. How long before we have a conclusive decision on those two narratives?
At least I wish I could answer that question. I just think we're going to be in this choppiness though for a while here, and so I think we're just going to have to live with that. And I think what you need to do is we need to step back and we need to say, okay, we all look at this data today, and what does this mean for the Fed next week? What does this mean for the Fed in May? The Fed doesn't at this point. It doesn't really know either. It's taking these data in its entirety as they come in, and it'll make its decisions as we go forward. And unfortunately, I think we're going to be in this choppiness, for a while.
So right now, as we take a look at the way that the market's responding, we see stocks really shrugging off pretty much everything. We see bonds reacting, but in a controlled sense. What is the threshold for financial conditions and the easing of financial conditions to create a problem for the Federal Reserve?
So, if we continue to trend in this direction, stock prices going higher, if we continue to see bond spreads coming in financial conditions, and that juices the economy even more, I mean, that would be, I guess, somewhat of a problem for the Fed in terms of its easing path going forward. Now, they're not targeting stock prices. They're not targeting bond spreads. I mean, what they are looking at is the effects of these financial conditions on the overall market or the overall economy in general. People make a big deal out of stock prices. It does have a wealth effect on people, but those wealth effects tend to be pretty small. So the point here is you need to have a lot of financial conditions loosening here for it to really start to have an effect on the Fed's decisions going forward. And I don't think we're quite at that point just yet.
When it comes to Jay Powell, he continuously says at some point this year we'll be cutting. Does that change to later this year? Does this timeline just get pushed back?
I think it does, Lisa. Because what we're seeing is, yes, the inflation rate is trending lower. Now, it's not coming down as much as I guess people would like it to be. But what's happening is that inflation rate continues to come down, and the Fed remaining on hold, the real Fed funds rate is passively going higher. And that's acting then as a passive tightening on the overall economy. And so in some sense, they need to be cutting rates, maybe not in May, maybe not in June or July, but they probably need to be cutting rates later this year, or you're going to have a passive tightening of monetary policy, which then could potentially slow things a lot more than people are expecting right now.
Hey, Jay, I appreciate your views, your opinion, your reaction to this morning. Thank you, sir. Jay Bryson there of Wells Fargo.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.